Is your defined benefit plan going to get audited? I assume you hope not. Hi there, my name is Kenner French. I'm with VastSolutionsGroup.com. We've been in existence for over 50 years and are the first firm of its kind to marry defined benefit plans and artificial intelligence in a single effort to help entrepreneurs better their situation. Now, what follows is a top 10 list of auditable issues for defined benefit plans. This is mainly for those in the industry, but also helpful for an individual or a trustee who's looking to potentially adopt a defined benefit plan. Now, it's going to be technical, but it will be of value for you. Now, what follows, once again, the top 10 audit list for defined benefit plans. Minimum funding requirement. The IRS Code 412 provides for a violation of minimum funding requirements, meaning you're failing to receive contributions necessary to satisfy this code section. The results of a plan examination have determined that one reason for this failure is that not all eligible employees were being included in the plan, which led to improper funding calculations. It was also determined that in some cases, compensation was being included for funding purposes that should have been included in a subsequent or prior year. In addition, participating employees responsible for the excise tax that are resulting are not appropriately filed, meaning 5330 form. Delinquent or late contributions to plans, not good. Got to make sure that minimum funding requirements are not failing to receive contributions by certain dates necessary to satisfy the code section. When the plan receives these contributions late, these are consequences which can include excise taxes being assessed under IRC 4971. Now, to number 2, inadequate or no Fidelity bond plans. Plans are required to have Fidelity bond equal to at least 10% of the most currently handled assets. The maximum bond required is $500,000. Effective for plan years after 2007, the Fidelity maximum is increased from $500,000 to $1 million for plans holding employer securities. No deductible is allowed in the bond, and it must be in the name of the plan or the trust, not the employer, or the bond must specifically state that the plan or plans by name are covered and the general bond deductible doesn't apply per ERISA requirements. Now, number 3, vesting or benefit accruals via Code Section 411, including non-cash out forfeitures from lost participants and error in vesting percentages. Now, every plan is required to have provisions regarding how participants in their vesting are benefiting. Normally, the percentage of participant is invested in is dependent upon their credit service. If employers and or unions do not track a participant's service correctly, the vesting percentage should be incorrect. Errors that have been cited include the following: errors, cash outs and forfeitures, wrong vesting schedules being used in errors when calculating participants' vesting percentage. Number 4, prohibitive transactions. This is big. Loans are made out of the plan that don't provide for them. In addition, loans are being made to people considered to be disqualified. A specific trouble area relates to loans being made to highly compensated employees that violate one or more of government exemptions. There are also these things called 72P violations due to the original excessive length and or amount of loan exceeding either 72 or plan requirements. IRC 72P violations are being found in relation to the failure to meet the level amortization requirements, which require that payments be made at least quarterly. Number 5, participation coverage. Plans are failing to meet, we're finding, the testing requirements of Section 410B due to the fact that they're not following participation entry requirements of the plan and law, which is resulting in the late entry of employees who must be included for testing purposes. Number 6, discrimination of contributions benefits plans, as an example. They're not required for adjustments of benefit payments benefiting the normal retirement date. The actual required adjustment to interest payments are not being paid to participants whose retirement benefits commence after the normal retirement date as stipulated in the plan. The issue tends to be more prevalent when plans have normal retirement ages that are less than 65 because many participants are unaware of their eligibility to receive benefits at the earlier age and thus fail to apply for their benefits. Now, errors are made when participant benefits are calculated. The following reasons for these mistakes have been identified quite a bit. benefit provisions in the plan are misapplied, applicable law is not understood, faulty participant data is used or provided by the employer and/or union, or combinations of the above. Number 7, deductions, including actuarial, etc. Contributions are not being made on a timely basis due to the fact that they aren't meeting the deadlines. Deductions are deemed timely, paid on the last day of the preceding taxable year if the payment is on an account such taxable year and is not made later than the time prescribed by law for filing the return for such taxable year, including extensions, by the way. Excess contributions are being made. Well, basically the maximum amount that can be contributed to a defined benefit plan is as follows. The amount necessary to meet 412A minimum funding requirements, the amount necessary to provide all employees under the trust the remaining unfunded cost of the past and current service credits distributed as a level amount or level percentage of compensation, or over the remaining future service of each such employee, an amount equal to the normal cost of the plan if past service is provided, an amount necessary to amortize those unfunded costs over 10 years. Number 8, non-late or amender filings. Essentially, if your plan needs to be amended, make sure it is so. Required distributions, because administrators typically rely on participants to apply benefits before addressing such issues, the required minimum distribution requirements are not being met. Specifically, many plans have failed to make required distributions to participants by the 1st April following the latter of the year he or she turns 70 and a half, the calendar year in which he or she retires. In addition, when participants die, the rules governing the timing of such distributions to their beneficiary are not being followed. I'll note, the Secure Act deferred the age of 70 and a half to 72 for participants turning age 70 and a half and after December of 2019. Now, joint survivor in the IRS Code Section 417 violations include spousal consent and with respect to the adjustment, the non-spouse beneficiary is more than 10 years younger than the employee, and of course quadro. The issue deals with the specific rules affecting married participants who are approaching retirement and or are ready to commence receiving benefits who elect to receive their benefit in a form other than qualified joint and survivor annuity. Now, the IRS has a system of correction programs for plan sponsors or retirement plans, including defined benefit plans, which are intended to satisfy IRC requirements but have not met the requirements for a certain period of time. This system, the Employee Plans Compliance Resolution System, EPCRS, permits employers to correct plan failures and thereby continue to provide employees with benefits on a tax-deferred basis. Now, if you have any questions, this is technical, I will admit. If you have any questions, please look us up on the web at www.vastsolutionsgroup.com or give us a call, 888-808-8278. We're here to help. There's very, very specific things to watch out for, and we do a lot of consultation, a number of plans, clients all over the country. We're here to help. Once again, my name is Kenneth French, and it's indeed been a pleasure to spend time with you, and my hope is we can help make your journey a little bit easier with respect to defined benefit plans. Thank you, and have a great day.